Fire up the Bengals. Just another manic Monday. Guys, I'm sorry. From time to time I sing here, and I probably shouldn't. But anyway, I had a crush on the lead singer, Susanna Hoffs, back in the day. And I don't know if you've seen her recently. So looks pretty good. Anyway, Manic Monday, another one. How many people remember where they were Lehman Friday? Lehman Friday, what was gonna happen on Monday? Yeah, I remember exactly what I was doing and what was going through my mind over the course of the weekend. And I said it's gonna be a tough slog. It's gonna be a tough slog because again, people when things get out of control, when there's various different ideas being thrown around, when there's worst case scenarios put out there, end of the world as we know it, all sorts of stuff. People do dumb things with their money, really dumb things. And that's usually what we're battling against all the time. All right, let's talk about SVB. We talked about it last week. We've had, Signature Bank went down. This is a crypto bank. But because of some of the actions by the FDIC and guaranteeing deposits, Bitcoin all of a sudden rocketed through the roof. I don't get it. I'm going to take that and put that aside. Regional banks around the country were in a situation where it's sell first, ask questions later. It is. The real teachable moment is about this entire episode is that the people over at Signature Bank are actually on the board of the San Francisco Fed. Mary Daly she's in charge of the San Francisco Fed. She's supposed to be appointed to the board of governors. What the hell do you guys do for a living? I'm going to be honest with you. I didn't look at Silicon Valley's balance sheet. I didn't. I don't own Silicon Valley Bank. But it wouldn't have taken very long to see the issues that they had. For crying out loud, let me just show you how bad all of these people are. KPMG signed off on SVB's books and Signature's books within the past couple of weeks. This doesn't lend itself to confidence by any stretch of the imagination, does it? No. So what we had this weekend was panic mode. I wasn't in panic mode. Again, you had the usual a-holes, the usual suspects out there, the Bill Ackmans of the world calling on the government to do something. If you remember Ackman, he was that jerk. They actually parodied him in that financial show. It's kind of a dark financial show on HBO. I can't really watch it. Industry. When he went on CNBC, what was his name, with Wapner? And we got to shut the country down. They're going to kill my dad. I love my dad. All he did was freak everybody the hell out, crash the markets. And what did he do? He positioned himself. Before that, he made himself a fortune. Those guys they're jerks. They're players, but they're jerks. They're part of the big club that you and I are not in. He was out this weekend. David Sachs, oh my God, fear, panic. Oh, it's terrible. As it turns out, the only, I think it was the UK subsidiary of SVB got bought by HSBC for £1. A pound. What is that now? I don't know. $1.20, $1.30. I don't know. Okay. I am going to do my best again to try to explain what happened. And just, it's amazing at just how stupid these people in positions of power really are. Okay. And again, this is basic stuff. This is stuff, back was on my Series 7 exam that I took decades ago. The concept or the idea out there that there is no risk in government security. Oh, it's the U.S. Treasury. It's solid. Okay, you're going to get your money back at the end, but there's this thing called duration. Okay. All right. What does that mean? Duration risk. Okay. Somebody who's, let's say, 50 years old. 50 years old 2 years ago. 2 years ago, wants to have cash and cash equivalents in their portfolio. Let me tell you what's not a cash equivalent. Treasury bonds with long durations. What do you mean? What do you mean? They're liquid. You can get them. Wait a second here. At what were they? 1.25%, 1.5% for 30 years? How many times on this program did I jump up and down, yell and scream, who in their right freaking mind is going to lend money to Uncle Sam for 30 years at 1.5%? Now, again, the shorter term durations were yielding even lower. But who gives a shit? Who cares? At least you can get out. Exactly. Where could did you expected rates to get lower? Did you expect them to go negative? Why in the world? Why in the world would a bank that might need access to its capital quickly to deal with depositors go long? Again, let's back up a little bit. All right. COVID crisis, tech companies, Zoom, all these things are going through the roof. Big hype cycle situation. So banks that funded a lot of this nonsense, Signature Bank, also obviously Silicon Valley Bank, they had a lot of money. They had so much money, they didn't know what to do with it. Again, they would strike deals with the people that they were funding their companies and said, hey, we're going to lend you money that will constantly roll over. We'll keep your startup going until you can cash out and convince some fool to buy it later on down the road. We'll talk about that in another podcast. It's an entirely different topic. But anyway, they kept their money there and they had an enormous amount of money that they couldn't lend out. So they instead decided to go out and buy 30 years. Now, we have the Fed come out and finally realize, maybe this inflation thing is not transitory. And you have all of these members of the Fed, Jay Powell, coming out and saying, we are raising rates. We have to deal with inflation. Now, anybody with half a brain, okay, would say, whoa, I own all of this paper, this paper that's 30-year duration. Oh my God, it starts raising rates. The value of this paper is going to drop. Understand? It's an inverse relationship. And that's what they did. But they didn't sell. They could have gotten out a year ago. They could have gotten out 18 months ago based upon what the Fed was signaling, but they didn't. I don't get it. I'm also learning as well that the people that held money in Silicon Valley Bank, they didn't have it swept into money markets. It was just kept. I'm trying to make heads or tails out of this, and quite frankly, it doesn't make a lot of sense. It doesn't make a lot of sense. And right now, the search is on for who's next. Who's next? What else is going to break? I know we're told Joe Biden came out today. Taxpayers are not going to foot the bill on this, and the people that own stock and the bondholders and all that, they're going to get hit. There's something called, I've talked about this before, it's moral hazard. This is going back to the auto bailouts, goes back to 2008, 2009 bailouts. And technically, again, the government bailed them out. The government made money on all of those deals. So you go on TV now and you see all of these Silicon Valley types. What's funny is is that the Silicon Valley types today, they have like the goatee, which was in vogue back in the 1990s for a lot of entrepreneurs, but they got crazy hair. They got crazy hair. I'm watching this thing. I said, I got to invest in Vidal Sassoon or something like that. These guys use a lot of gel. Anyway, neither here nor there. They're coming on and they're applauding. Oh my God, all of these people deposited money they didn't know. It wasn't their fault. People, your deposits at your bank are insured up to $250,000. Period. The end. Period. The end. You want greater insurance? I mean, what's ours? 150 million? Do something different. Your bank up to 250,000. So what they did this weekend is they said, nope, we're going to push that aside and we're going to make everybody whole. All the depositors are made whole, even ones, it would have been automatic if you're under 250,000, but it was funny, 70 to 80% of the depositors at Silicon Valley, it was uninsured deposits. So these are people who had a lot of money in that bank. And again, that was the bank telling them, hey, you want to keep rolling over these loans, which these startups have to do. Again, it's not like they're paying their debt off, people. Do you understand? It's like our government. It's not like they're paying their debt off. They just, there we go. We got to roll the debt over again. Got to roll it over again. Now that interest rates are higher, it's going to cost them more. But anyway, no, I don't believe there should be any taxpayer bailout when it comes to this. I'm going to go over a couple pieces today. I'll start with Andy Kessler, big fan of his piece today, who killed Silicon Valley Bank. Again, same thing that we're saying here. Apparently no one at the firm perceived any risk from the Fed raising interest rates. No risk at all there. None. Again, I've been talking about this as of late where, I think rates are fair. I like, this is a normalization of rates, and I have no problem where they are. Again, would I, because again, like I said, my kids are on their way close to college 2 years ago, say, gee whiz, I gotta keep this money in cash, but I want to get some return on it. I want to get some return. Oh, gee, 30-year treasury, 1.5%. I would rather take my money. I said it in the show. You remember those cans that our grandparents used to have? It used to be my piggy bank. Remember, it was a tobacco can, Prince Albert. I used to keep my money in that. Yeah, I'd rather keep my money in a freaking can. I mean, what did you think was going to happen? Do you honestly think that rates were going to stay at those levels? Do you understand how risky that is? I guess not. These are smart people running banks, right? Hey, listen, I deal with morons that manage money that were doing the same stupid thing. But anyway, back to Kessler's piece. A lot of money to put to work because of what happened with COVID and all of the startups. Again, searching for yield. Bear Stearns did the same thing. Lehman Brothers did the same thing. But again, this is the thing that boggles the mind, is that they knew rates were going up and they didn't do anything about it. I mean, the reality is that they had people money, after last week, the CEO bumbled his statement in regards to what he needed to do. He had money coming out of the bank. It wasn't that much. He should have been able to handle it. And he didn't. I want to share with you Vivek Ramaswamy piece today. SVB doesn't deserve a taxpayer bailout. Again, Vivek is running for president. And again, he's talking about the moral risk here. To the extent that failing to make SVB's uninsured depositors whole would have heightened the risk of a run on other banks. The Federal Reserve should have played its role as lender of last resort. Another option would have been to increase the FDIC coverage limit to a level that would avert a run, shoring up public confidence in other U.S. banks without showing favoritism. 11% of its deposits were insured. That's it. That's it. These are all of these tech guys. Again, they're portraying themselves on TV. Oh my God, these little parents and that are out there with their kids and they're at little league games. No, these are very, very wealthy people. And quite frankly, they should be a little bit more sophisticated in how they go about handling their money. Again, usually banks sweep excess cash do that with treasury bills and other securities. They didn't do that. Vivek puts out Roku, which is that streaming device company, had a $487 million balance with the bank. And again, who what was Silicon Valley banks? Who were their clients? These were startups. These are companies that were very, very sensitive to interest rate risk. Very sensitive. Like I said, they have to constantly roll their debt over. Again, regulations require banks to hold high-quality liquid assets. These can be categorized available for sale, AFS, or held to maturity, HTM. Now, this is the kicker. All of these banks, because of accounting rules or whatever, all of these 30-year treasuries, all this paper that they held, which was in the frickin' tank, they weren't even showing on their books losses due to that, even though they were taking heavy losses. Booking bonds and held to maturity prevents gains and losses for showing up on your books. SVB booked $91 billion out of $120 billion in the most favorable HTM category and only had $26 billion available to sell right away. They didn't hedge interest rate. Again, it's a disaster. It is. And again, people, we're going to watch it. You're going to be smart if your portfolio's handled. You're going to be okay. You're going to be okay. But again, if you need a little hand holding, that's what we're here for. This is what we're here for on Manic Mondays and Manic Tuesdays or any day of the week. It's what we do here at the WatchDog on Wall Street show and Markowski Investments. Please, I invite each and every one of you, get to our website, personal CFO program, account repair kit, shoot us an email, give us a call, okay? There's no reason to be distraught by this. We will point you in the right direction. WatchDog on WallStreet.com. It's WatchDog on WallStreet.com.